Just about everyone loses money in a bear market. They're the hardest part of the stock market cycle, and they can be an emotional nightmare. So how should you handle a bear market? Well, that's what I'm going to tell you in this video. I'm Jason McIntosh, and as always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's jump over to our first chart. So this is the S&P 500, but look, it doesn't really matter which index you look at. Volatility's been picking up around the world, so no matter where you live, chances are your local market is either in a bear market or it's getting close to it. So what exactly is a bear market? Well, the definition of a bear market is a market that's down by at least 20% from its high. So here's the high here, and here's where the S&P 500 is now. So in the US, the S&P 500 is down around 18.5% at the time of filming. The NASDAQ, well, it's down even more. It's officially in a bear market. It's down around 27%. If we then jump over and have a look at what's happening in Europe, the Euro Stoxx 50 index has been down as much as 23%. So it's in a bear market. We could then also look at emerging markets. So an emerging market ETF, and you can see emerging markets, well, they're down a lot as well. They're down somewhere around 28% overall in this ETF. Doesn't get any better when we go to Japan. The Nikkei has been down. It's been down as much as 19%, so not quite bear market yet, but look, pretty close. And then we go to the Aussie market, and it's holding up relatively better. It's only down 12% when you look at the main ASX 200. But if you go over and take those big stocks out of the index, and you look at the small ordinaries, well, they're down around 20%. So overall, it looks like bear market territory pretty much everywhere you look. So how do you handle it? How do you handle a bear market? Well, let's go through that now. So I think the first big thing that you need to do is to know what's in your portfolio and know why it's in there. So maybe you bought a stock for fundamental reasons, or maybe it was something to do with a technical pattern or technical setup that you liked, or perhaps it was a mix of both. No matter what way the stock got into your portfolio, you need to ask yourself whether the reason you bought it is still valid. And if it's not, then ask yourself, look, would I want to buy that same stock today? And if the answer is no, then it's probably time to sell. I'll show you an example of what I mean by this. I'm going to show you a stock from my own portfolio. Now, let me just call it up on the charts here. So it's a company called iCandy Interactive, listed on the ASX. Now, this is it's an interesting stock. It's a small speculative stock, and their business is game technology. They develop games, video games. And so what I did, I was following a technical setup. The moving averages, you can see, had turned higher, and the shares just here were breaking upwards. That's where I bought a position back in November. There was an initial strong run, and then the stock started moving sideways. So from my perspective, where I'm targeting medium-term trends, that was all fine, because often a stock will consolidate after a big move and then continue higher, but not always. So just along here, there was a support line which I was watching, and just in the last week, the shares started to fall back, break below a support which had been holding the market for several months, and had traded back to my entry price. So the reason for owning the stock was no longer there. I bought it based on a breakout. I was happy to sit with the consolidation, but holding as the stock starts to reverse and trade below my entry price didn't make any sense, so I sold. I sold just around this point here about a week or two ago. The stock is now down another 25%. So there you go. This is one of the big things to remember. Rule number one, in a bear market in particular, if you don't have a good reason for holding a stock, make sure you get out. There's no point having a stock like iCandy stay in your portfolio and continue to deteriorate once your reason for owning it is no longer in place. All right, so let's move to our next rule. And the next rule, and this is a really big one, this is such a big rule in a bear market, and it's don't average down in individual stocks. Now, I just want to differentiate that from people who dollar cost average into an index fund. That can be a great longer term way to grow wealth, staying with an index over time and averaging in, month out. That's fine. Individual stocks are a completely different proposition, because an individual stock can go to zero. An index, well, that's probably not going to happen. It's probably not going to go to zero. So individual stocks bring a whole lot of extra risk to the table. And averaging down into individual stocks is actually one of the worst strategies, I think, of all time for the average everyday investor. And it's a dangerous strategy, and the way a lot of people apply it, it actually is more of a gambling type of strategy than one that can accumulate wealth over the longer term. Averaging down, well, it's bankrupted banks. Barings Bank in the 90s was bankrupted by an averaging down strategy which combined leverage, which is even a worse way to approach your trading account. And it's also wreaked havoc with so many individuals over the years. So why do people average down? Well, one of the big reasons people average down is that they think if they say they buy a stock for $1, it falls to 70 cents. A lot of people say, well, if I double up at 70 cents and the stock has a bounce, I'll get back to even quicker, and then I can sell and I can get out at evens. That's not even like a long-term investment strategy. That's just a strategy to try and break even, and it's a bad strategy at that. Because often it's a case of throwing good money after bad. So ask yourself this. Say you average down and the shares don't bounce back. Say they halve again. What do? Do you buy more? And then they halve again. Do you keep buying? And this is what a lot of people do. They'll average down all the way to zero in some cases. So it can be a complete disaster. So this is why I say averaging down is such a dangerous strategy. And I'm going to give you an example. I'm going to give you an example of how even sophisticated investors can get this wrong. So let's go back over to our charts. I'm going to call up a chart for a company called ARC Innovation. It's an ETF. Now this was one of the poster ETFs, poster stocks for high growth companies which aren't making a profit during the internet or during the COVID recovery. During this period here, from the COVID lows up through until February 21, this was a boom stock, and it was all the rage. Everything to do with technology, new technology, high growth. This company was all over it, and they did really well. And what's happened since then, though, as technology has come off the boil, and particularly the technology stocks which aren't making money, this stock has fallen considerably. It's down over 70% over the last 18 months. So it's gone from a boom stock to a disaster. Now, what I want to do with this, I want to show you how ARC Innovation has been managing some of the stocks in its portfolio, and it's actually used this strategy, this averaging down strategy, across quite a number of its stocks. So let's just jump over to here. Now, this is Zoom Video Communications. So you probably know Zoom. It was one of the boom stocks of the COVID recovery, and it's actually the second largest stock in ARC's ETF portfolio. Now, let's start by looking at this purple line it starts at the bottom of the screen and ends up here. That's showing you the number of shares ARC owns in Zoom Communications, Zoom Video. So you can see it's been continuing to buy the shares over the last 18 months. Now this yellow line, this is Zoom's share price since the peak. So Zoom's been a disaster over the last 18 months. It's down something like 85% through this period. Yet despite the declining share price, the ARC ETF has been averaging down. They've been buying more shares. And this purple line you can see through here, well, that's the light purple dotted line. That's the average price. So you can see they've been lowering their average price as they've bought more shares. But as you can see, it's been a calamity. Averaging down has been a wealth destroyer. So that's rule number 2. Just don't do it. Unless you're really confident around the strategy and you have exit strategies around where you know you're wrong, averaging down as a strategy which is best left alone. Okay, so let's jump over to number 3. Rule number 3 for surviving a bear market. And that is, and this is a key strategy, it's have an exit strategy. Know where you're getting out, know where you're wrong. Everyone who buys a stock should know where their maximum pain point is for each holding. So while we don't know what the market's going to do next, if we have a good exit strategy, we know what we're going to do, whether we're going to hold, whether we're going to sell. That's all tied up in your exit strategy. So your exit strategy, look, it's a bit like an escape hatch. It gets you off the playing field when the game starts going against you, and this works in terms of both profitable trades and losing trades. So I'm going to give you an example. Now this is another real life example from my own portfolio. And let me just call this up. So this is from my trading software, which I use for my Motion Trader subscription service. And this is a trade, because I follow these trades for my service myself. And this is one which I did follow. So I bought this stock in a company called Universal Biosensors. It was back in July 2000. Now this red line beneath is my trailing stop. So my exit strategy is to use a trailing stop. Trailing stops aren't the only exit strategy. There are other ways which can work as well. The key is that you have one, but this is the one that I use myself. And you can see, like, the key to my trailing stops, it's a calculated exit level which uses the stock's volatility and percentages to work it out. So it's not discretionary, it's calculated. See this red line beneath the share price? That's a trailing stop tracking up beneath the share price for UBI. That's a ticker code for Universal Biosensors. And notice how it always gives the stock lots of room to move, because pullbacks and consolidations are a normal part of how a market operates, and you've got to give a stock room to move if you're to stay in a trend. Like these pullbacks here, these were could have been 20-25% pullbacks. You've got to give them room to move to stay on the trend. But at some point, the trend's going to bend far enough that it's going to come back and hit the exit stop. The exit stop's like your line in the stand. It gets you out when the trend appears to be changing. And so this is a stock I sold about 2 weeks ago. It had been a great stock, but it's come back, it's hit my exit strategy, and I'm out. And that locked in a gain of around 180%. So a great trade with a strong exit strategy sees me walk away with 180% gain. But many people don't know when to sell. They'll get these big gains, so let their profits run and get a really good outcome from that perspective, but then they don't know when to sell and they don't know when conditions change, and they can end up, in a lot of cases, riding a great trend like this all the way back down to where they got in. I've seen it happen so many times, but that's completely avoidable if you have a good exit strategy. So UBI is down around, since I sold around here, UBI is down around 35%. So that's rule number 3. Have an exit strategy that tells you when to sell. And now I'm going to move on to rule number 4. But firstly, look, if you're getting value, please hit that like button, and also maybe leave a short comment. Just say, hey, thanks for the video. It tells YouTube people are watching, people are engaging. And if you do that, YouTube shows more people watch, and I make more videos. So that would really help if you could please do that. And if you haven't come over yet, come over and check out my Motion Trader website at motiontrader.com.au, because I've got lots of great resources there which could help with your trading and investing. So it'd be great if you jumped over and had a look. So that said, let's go over to our final rule number 4. And that is, keep perspective and be patient. It's just so important that you do this. I know these are difficult times, but look, I want to call up, I'm going to show you one more chart to help put everything into perspective. And so let's just call up a Dow Jones chart, and I'm going to put this on a monthly chart so we get lots of data, and I'm going to put it on a log scale, which is great for looking at these longer term charts. So there we go. So this goes back to 1897. So what's that? 123 years worth of data. And look, corrections and bear markets, you just got to always keep in mind they're part of the cycle. Yes, they're difficult. Yes, they're frustrating, but it's how the market works. So just looking at this huge advance over the last 120 odd years, it's so easy to see the big sweeping rally and then not pay too much attention to the pullbacks along the way. But when you work it out, it turns out that on average we get a 10% correction about once a year. We get a 15% correction about once every 2 years, and then once every 3.5 years on average we get something that corrects around 20% or more. So the COVID experience, the COVID crash and recovery, I think that's given a lot of new investors the wrong impression of a bear market, because the sell-off was over in just a few weeks. The market crashed 35 or so percent in about 6 weeks, and then we had this really strong rebound recovery rally, which then went on and took many markets off to new all-time highs. But that's not how a bear market typically works. Bear markets they're often volatile and they're grinding, and they can go on for maybe 6 to 12 months, sometimes even longer. And the closest experience which I can think of to the COVID crash was this period in here, and this was the 1987 stock market crash, because you can see the market fell rapidly, and then in the US at least, didn't happen elsewhere around the world. In Australia, for instance, it took several years during a recession moving sideways. But in the US, the market started recovering pretty quickly and got up to new all-time highs. And then here you can see there's what looks like a little bit of a blip, and then the market continued upwards. This blip is a 25% correction, the type of correction that we're potentially having now, which is causing so much angst and concern to so many people. So look, just remember, these are a normal part of the market cycle. And so look, just remember that these are difficult times, they're stressful times, and they can be really unsettling. But the key is to have strategies that minimize your risk and help you exit stocks which aren't performing. Because what we want to come out the other side with a lot of our capital intact and with our emotions intact. And once that happens, if you can do that, then you're ready to take the new entry signals when they'll inevitably come on the other side of what for most people at the moment is a bear market. So hold in there. This time will pass. They all do. And look, come over and visit me over at Motion Trader, motiontrader.com.au. And I look forward to talking to you again in another video. Okay, bye for now.